Are you planning on leaving your wealth to your kids in your will? If you are, you're probably familiar with the 3-generation rule. This is kind of a little short rule of thumb that says that money usually doesn't last beyond 3 generations. First generation makes it, that's you. Second generation enjoys it, usually your kids. Third generation blows it, usually the grandkids. So in this video, we're going to talk about how you can use a properly structured life insurance policy to build a trust that distributes your wealth for generations to come in a quick, private, and tax-free way. Let's get started. It all starts by putting your money into a participating whole life insurance policy. And we do this for a couple of reasons. First, the premiums that you put into this type of policy grow with a dividend that's paid out every year by the insurance company. There's other videos that we have here on YouTube that talk about how that dividend is calculated and how you get it. Just go on youtube.com/SavePacific to see it. Second, the money that you contribute to the policy is very liquid. And so you can leverage this from anywhere from 80, 90, or 100% loan to value ratio, which means that you'll always have access to the money that you put into the policy in a very tax efficient way. Now, why is it tax efficient? The money that grows inside the life insurance policy is tax deferred. And when you leverage the money out as a debt or a loan, well, loans aren't taxable. So you can leverage this money in a couple different ways. You can do what's called a policy loan straight from the insurance company, or you can do a collateral loan from a bank or a third-party lender. Now, you can use the money that you take out via loan from the policy for whatever you want while you're alive. You can invest, you can supplement your retirement, you can help to pay for your kids' major life milestones, like helping them buy a house or go to school. So now what you've got is an asset that you can access 80 to 100% loan to value that's consistently growing with a dividend every year. Then, when you pass away, the death benefit pays out minus any outstanding loans that you've been taking throughout your lifetime. And your beneficiaries would receive all of this money from the death benefit in a tax-free way. So what happens with that death benefit? How does it work? It pays out quickly and it pays out tax-free to your beneficiaries. Just like a will, you can structure the division of how you pay this out however you want. But unlike a will, when you name the beneficiary on your insurance policy, nobody can contest that or challenge it. So if your death benefit is $10 million, you can allocate $1 million each to 3 of your kids and $1 million each to your 7 grandkids. You can divide that death benefit amongst however many people you want in whatever distribution you want. So in this example, if you want to leave your 3 kids $2 million each and then divide the rest amongst your grandkids, you can also do that. However you set up the insurance to pay out to your beneficiaries, the insurance company will pay them out like that, and nobody else can change that. Another thing about this strategy is that it ensures you can provide a legacy for generations, right? It's what you can set this up through a trust, or you can even set up what's called an annuity settlement option. So you can say, well, I want the life insurance to pay to my beneficiaries, but I want to give them this much per year for X amount of years, or every month or every 6 months or whatever. This is a great option if your beneficiaries are younger, or maybe they're not good with money, or maybe they have other issues like gambling or drugs or alcoholism, which happens a lot. Another option to ensure a long and steady family legacy is to use this exact same strategy across multiple people. So when you purchase life insurance, there's 3 main parties to that contract, right? There's the policy owner, who's the person who pays the premium. There's the insured, who the insurance is covering. So when that person passes away, the insurance pays out. And then there's the beneficiary, is the person or the people who will receive the death benefit the insured person passes away. So as a parent or grandparent, you can be the policy owner where the insured is your child or your grandchild. We can set this up so that your child or your grandchild becomes the contingent owner of the policy, which means when you pass away, they automatically become the owner, which allows a tax-free ownership transfer of that policy. You can also transfer the life insurance policy to the life insured child or grandchild while you're still alive so that they can access that cash value. And then since the insurance is on them, when your child or your grandchild passes away, there's a life insurance payout to their kids. So you might be setting this up on your grandchild, paying out your great-grandchildren who you might not ever even meet. So if you're talking about legacy, like that is a pretty amazing legacy. And then with this strategy, the way we're setting it up, the money's never spent that's inside the policy. It's only lent out which guarantees that the family legacy stays together for generations. So there you have it, a strategy that allows you to set up a lasting legacy for generations without the worry of it dissipating once you're gone. I hope you enjoyed this video, and if you did, please hit like and comment and share, do all those things that help the algorithm pump it to more people. That's it for now, and I will see you next time.